Hi, this is Pete Birchler of StockMarketAlchemy.com. It is April 15th after the market close here in the U.S. And what I'm going to do today is review a few different markets, maybe in no particular order, so bear with me here. It's kind of off the cuff. This first chart we're looking at is the S&P 500 cash chart. And this is a weekly chart. We've got a stochastics indicator down here. This is a 7-period stochastics, and there is a parabolic SAR study on the chart as well. Yeah, I believe in the last video I mentioned that once we see the blue line, the %D of the stochastics go down below 80, that could be a first indication that this leg up is complete and we are then in the midst of a correction. We have not reached that just yet. However, if we finish the week this week, even if it closes just relatively near to where it is right now, and then we see some type of downside next week, that could probably move below the 80 level. So keep an eye on that stochastics. Additionally, price is now not far above the weekly parabolic SAR, so the reverse, stop and reverse trigger point here. And over the last number of legs up, they've been pretty good at keeping you in for the majority of the rally and then getting you out near the highs of the legs up. So if we do see that trigger, I think that's a sign the easy money's been made. Possibly we see some higher highs, but it could turn into a choppy affair, kind of like we saw in 2011 as well, especially given that we are entering the seasonally weak time from May, May and then on and through the fall into September and October. So we might not expect the best gains to be made over the next few months. They're probably already made in this past November to April time frame, which is historically when most of the gains come in the stock market. So that's what to look at there, or at least what I'm looking at on the weekly chart. As far as where the S&P 500 is, in its move up here, let's zoom out a little bit. I've had this red box here and these projection lines on the chart for a couple months now as an indication of where a typical leg up in a bull market would be expected to top, given historical averages and given some closest fit type of precedents from the 2000 to 2012 time frame, basically. So we're right in the midst of that box here. This has been a relatively normal median leg up in a bull market. So this is very close to the typical leg up in a bull market in terms of price and time. Given that, we should be alert as time moves forward here for any type of technical sell signals, because we're starting to get beyond the average or median leg up in history. So anytime we see the market move beyond that, it's extended to some extent. It doesn't mean it has to top, and that is not to say there aren't legs in the market that go on for months and months and better parts of a year. But in any case, we are in that live area where we could possibly anticipate a reversal. And one factor here that makes this potential for a reversal, let's move back to that same chart here, is that finally the S&P 500 has broken the 2007 high. So it topped at 1576.09 on October 11, 2007, and it has poked above that here as of last week. So now that that high has been exceeded, that does set the stage for a more probable topping area in this leg up. Highs like that are made to be broken. When they're broken, it creates the possibility of a bull trap where you have kind of headlines made and late money coming in and that type of thing. So doesn't mean it has to top here, but I think that even if the bull market continues, now that we've seen this high broken, we're probably in a live area to expect a correction in the market. Now, moving along to a couple other charts, let's look at the Dow here briefly. So this is the Dow. This is a daily chart showing a MACD down here, and we can see that on this last push up, there is now a pretty sharp divergence on the daily MACD on the Dow, and price is right at this three touch point trend line after today's decline. So if we do see a break of that trend line coming off this divergence, and then if we see the MACD actually decline below the low of this February decline, that would be added indicator confirmation that we may have seen a high in place. Now, as far as a measuring tool for that, one way to use the MACD as a trading instrument when you're looking at these divergences is you don't just trade as soon as there's a divergence or as soon as there is a cross. What you want to do is wait for the MACD line itself. So this would be the light blue line to actually move below in this case, the trough or lowest point that it reached during the divergence period. So here's where the MACD peaked out back in February, and then we saw it decline down to here, and it's yet to exceed that peak on the way up here into April. So what we really want to see for a entry trigger to short this would be for this MACD to move down below this February trough in the MACD. And then as a measuring tool, what you can do is you can take the move from trough to peak, so in price terms, and then once that MACD triggers, you can take as an initial profit target half of that move. So let's say that triggers down in this somewhere. What we'd want to do is we want to take half of this point value and or percentage value and project that as our first profit target. In many cases, that ends up being right around the trough of the price movement or the price low that corresponds with that trough. So in any case, that's one option here. Once you have that initial profit target met, if it does meet that, then you need to have some type of secondary strategy, hopefully playing for a bigger gain, using something like the weekly parabolic SAR or something to that effect, where you move your stop down consistently as price moves in your favor, if it does move in your favor. So that's where I believe the stock market is at. As far as the commitment of traders data, there's not much change over the last couple weeks. There was some covering or decrease in the net short position by the smart money as of the last reporting period. That only goes up through this past Tuesday, and this past Wednesday was the very large up day when the S&P 500 broke to a new all-time high. So I think this weekend's report will be more telling. It'll give us more information on what the smart money is doing on the breakout. So if they increase their short position significantly in this reporting period, which includes the break to new highs and a significant price move, then I think we would have some added confidence that we probably are near to either within a correction currently or possibly near to the beginning of a correction here. Because that means that despite the new highs and despite the technical breakout, they're still trying to cap the rally, and they're still confident in shorting the rally. Now, if we see them cover significantly or decrease their short position significantly on the breakout, then I would have to believe that there's the possibility that we do see additional upside over the next several weeks here prior to any possible correction. So if there's anything of note after this weekend's report, I will update on the blog here, but as of right now, really no change in outlook. We've had a historically extreme net short position combined in the indexes, and what I would be looking for at this point is simply a longer term type of sell trigger or break of support to indicate from price action that the primary bullish trend may be done. All right, so initially that would just take the form of some type of weekly time frame sell signal that implies we're in a correction. You may want to look at some larger time frame type of signal, maybe a monthly type of signal, if we are anticipating any type of bear market environment to come here. Now, I wanted to cover a couple other markets. The first one I wanted to look at is gold, because I had mentioned this in the last update. And let me move out to a daily chart of gold here. what I had mentioned in the last update, which I believe was right around this area in here, is that if price broke below this February low, that would be a significant technical failure, and then if price broke this 1530-ish level, this horizontal support line that's been established the last couple years, there could be some additional follow through downside. And this is something I've mentioned. I noted that possibility back in last spring as well. However, price came right down, touched the support level, and then put in a big rally. This time, the fourth time it's come to this support level, obviously there's been an absolutely tremendous move down in gold over the last two sessions here. So I guess my point in bringing this up is I gave some foresight of this over the past year or so, but I think it's just something that we need to remember. So at any time there is a major support level that's been tested 3 times, so we've had one significant support level here, retested again here, retested again here, and then we see the market break that support level a 4th time. That is possibly very, very significant. And what I think happens here, it's a very defining point in that what I believe is implied by this very aggressive downside price action is there's obviously this very large contracting or channeling type of price movement in gold over the last couple years. And in fact, it is the largest trading range environment in the history of gold prices since they have traded freely. And what I think basically happened here is you have obviously much of the trading is automated type of trading, algorithmic trading that happens via computers and that type of thing. And the character of the market, I believe, stayed in a relative uptrend type of mode as far as the computer algorithms go. But at the break of these lows, if you think about it, if price breaks this horizontal support level, there has to be some point where any of these automated trading algorithms have some type of stop loss in place and some type of area to protect the position if they're long. And there also is going to be some point at which the uptrend type of mode switches to a downtrend mode where the algorithms basically shift collectively and say, all right, this is now a downtrend environment. And I believe this is an absolutely tremendous confirmation that that is the case when we see this just tremendous follow through after a break of support. No buying left to be seen, and it just creates a vacuum under prices. We saw a similar thing happen in silver in 2011, and it's happening in silver here as well. Let me just click over to the silver chart. So we saw virtually an identical thing happen in silver here the last couple of days, where it broke this support level that had actually been tested 4 times in silver, I believe. Yeah, January 2011, September 2011, December 2011, and then June of 2012. And then finally that was broken now, and there's been some follow through to the downside. So on a long-term basis, what I believe this means is that we are in a bear market environment, clearly a longer-term bear market environment in gold and silver. Now, as is the case with many of these points of recognition, the easy money has already been made. The fast money has already been made. So if you didn't short on the breakdown, price is now down 12% or something to that effect. So what will typically happen is something like we saw here in September of 2011, where there's an extremely large move that happens over the course of a few days, and then you have a counter trend movement that takes far more time than that and retraces a significant portion of that move. What I would be looking for here in terms, as far as gold goes, would be looking for any type of multi-week rally that takes place once we see an initial break, support in gold and a rally occur, and look for some type of rally back under this support level to consider shorting gold. Possibly that might be months away here. From a seasonal perspective, most lows in gold come in the springtime, oftentimes in the June to July type of time frame. So we may see this market continue for the most part lower or put in a low here in a seasonal fashion in the spring prior to a significant rebound. Typically the strongest time in gold comes in the late summer, early fall, August to October time frame. So that's something to look for here, is wait for this market to experience some divergence before even possibly considering going long on it, and then look at possibly going long once you get some divergence and then a stable type of uptrend, and then be monitoring that for some type of secondary rally below the support level for a possible continuation of a longer term bear market in gold. As far as the smart money goes, the commitment of traders data on gold, they're relatively heavily net long on gold, near to levels where prior lows have happened during the bull market. However, when we see a shift of character and an obvious breach of price support, like we've seen here, we no longer can really conclude that we are in a bull market environment. So we will probably need to see further extremes in sentiment and in the commercial position before there is any type of lasting bottom in gold prices. Now, one thing I did want to point out is that these pink boxes here, this pink box is a replica of this one, which is the 2008 price decline in gold, which could be considered a mini bear market in gold. It declined about 30% in about 8 or 9 months. And what is interesting here is now, with this move to lower lows in gold here, this over the past couple sessions, this move down is far longer than any correction in the bull market in gold since 2001, when the bull market really began. So by that token, this correction and decline in gold has created an overbalancing in time, which is a concept that Gann talked about, and he really talked about looking for overbalancing in both price and time. And once we see price move below the 1300 level, which it's not far from now, really just a few percent above there, if we do see it break that, and then we have a decline that is larger in percentage terms than this 2008 decline, and the time is longer, then we're going to have solid confirmation from both price and time that this is most likely a longer term bear market environment. How long that'll last, I'm not going to bother with any type of projection here. What I will say is, historically in gold and silver, these are as far as looking at the commercial traders and the smart money and that type of thing, if you look at the futures market, this is a market that is dominated by hedgers. So the futures market in gold is primarily a hedging vehicle for producers of gold. So it is very, very rare that they will ever be net long, that the smart money will ever be net long in gold or silver, because they are typically net short, and they're hedging their underlying physical assets in gold. So one thing to look for in a bear market environment is to follow the COT data and look for whenever the commitment of traders report shows that the smart money, the commercial traders, are nearing or actually move to a net long position. If that occurs, that will often be a just a screaming longer term buy signal. It might not occur right at the low, but it should be an indication that price will be finding support when we see that happen. Now, that is not the case with either gold or silver yet. What I'm just saying is over the next several months or year or more here, if we see gold prices continue to decline and we see the smart money continue to increase their net long in gold, then we would want to keep an eye out to see if they possibly move to an actual net long position as an indication that the bear market may be drawing to a close in the precious metals. Now, as a related market here, let's look at oil. And oil also experienced a significant technical breakdown in that it broke below its first week of March low, and it broke out of this large triangle pattern here. So we can see that this is the USO ETF, which tracks oil, and if we move over to a actual futures chart of oil, we can see that it broke that low as well here in today's session. So the typical measurement tool for the triangle, what is traditionally the measurement, is to take the widest leg of the triangle. So let's take this leg here and project that down from the breakout point, and that would project oil moving down to around $70 a barrel based off of traditional charting mechanisms. Now we do have this 2011 to 2012 support line. What I would look at here from a charting standpoint is the next obvious chart support is not until around $84 here at the November lows, right here at the November lows. So I think at a minimum we will probably see price move rapidly down to that level. There just is no other chart support between where it currently is and that level. The next level would be the June 2012 low, and that in that region is also going to be this support line in blue here, this from October of 2011 to June of 2012. So we may find some initial support at that area, and I would say that's where I would suppose that we would probably see support, is we're probably going to see price move down, break this November support, and move down towards these levels. Whether a rally occurs there or not, I'm not going to speculate at this point, but I think that's going to be the live area as a possible first area of support underneath the market. If we do see it come down and break those lows, then certainly we could use that target down at the $70 level as a next chart-based target based off of traditional chart measuring techniques. So basically, if you're kind of following the logic here, we're looking at gold and silver likely in longer term bear markets where have a significant breach of support in oil. So all of these large commodities and inflation sensitive type of issues are declining at this point. So I think what that means is we're probably in the midst of another deflationary phase or type of theme in the markets. Now, how long that lasts, is it just going to be a couple month type of correction like we've seen over the last couple years, or is this now the kind of next shoe to drop in the economic crisis and we're in for a large scale deflation like we saw in 2008? I don't know at this point. What we'll want to do is follow some of the major or longer term support areas in these markets to get a feel for that. Now, one of the indications that I think will be the best feel for this deflationary type of environment and what's happening is the long-term U.S. dollar chart here. And I've showed this chart before, though not recently. This is a monthly chart of the U.S. dollar index, so looking at the U.S. dollar compared to other currencies. And what we're seeing is that the U.S. dollar experienced a very long and significant bear market from 2001 down to 2008. So it declined from around 121 to down to around 71. So a very significant move in the US dollar index. And what we're seeing here, I believe, is a potential very large scale head and shoulders bottoming pattern, so an inverse head and shoulders pattern with a clearly defined neckline between the 2005 and 2009 and 10 highs in the US dollar index. What we have also seen is we've seen this minor trend line from 2010 to 2012. This trend line here broken. So price broke that on this recent rally out. What we may expect is some consolidation here, but if price then continues to move up and breaks this larger scale neckline, the traditional chart measurement would suggest the minimum anticipated move given an inverse head and shoulders would be equivalent to this head to neckline projection projected up from the breakout point. And if that occurs, this is the dollar index move that we saw happen during the financial crisis of 2008. So if we see something that size or larger, what would the implication of that be? Well, I think the implication would probably be, again, another large-scale deflationary theme where we see stocks and commodities down in unison, and probably dramatically so. So this will be a chart, I think, to watch for a longer-term perspective on what's going to happen in the economy and stock market and that type of thing. So keep a longer-term U.S. dollar chart on your watch list to gauge what's going on here. So those are the main markets I wanted to cover. Is really this explosive action in the metals and the stocks and oil. The other chart I had mentioned in the last update was the bond market, and this update is probably a little bit late in coming, given the price action here, but this is TLT, which is the U.S. Long-term U.S. bond ETF, and it has formed basically a picture-perfect Gartley pattern to this point. So it formed a harmonic ABC declining type of pattern relative to this March 2012 to July 2012 advance. It has bottomed in the expected bottoming zone based off of my work on harmonic patterns, which is really where my website and my trading service is based off of these harmonic patterns, and pinpointing the reversals and then projecting the declines, and all along having an objective systematic entry trigger and stop movement system. So based off of the data in my harmonic trading database, what we would expect is for, if this is a successful pattern that is going to move to new highs above the July 2012 high, then the median time frame that we would expect that to take is around 0.6 times the time of the correction here of the ABC pattern. So that would suggest that we possibly see bonds at a new high here by the end of July. And that may coincide with the typical seasonal weakness in stocks, where we typically have this inverse relationship between bonds and stocks correcting into the fall and bonds possibly rallying into the fall. Now, I have written before over the last year or so that I think there are some indications that we may be set for a very long-term bear market in bonds, but at this point I think we have to respect this move up in bonds, concurrent with possible beginning of a correction in stocks. So as long as we see prices hold up above this 114, 115 level in TLT, then that would be indication to favor the long side of bonds with some type of trailing stop mechanism. So if we look at let's just put a